I was going to ask you 25 basis points or 50 basis points cut. It sounds like you're not even in the camp that we should be cutting right now.
Wait and see how the additional data comes in. We have a GDP report. I don't have to make a decision until the week of the FOMC.
The last print had a 3 handle in front of it. I mean, and you've been saying all the positive data. So it sounds like what you're saying is the cost of cutting while the economy is doing quite well is actually higher than the cost of not doing anything if we are headed into more uncertainty and a downturn?
Well, these are all judgment calls, and so in order to determine whether the economy has definitely slowed down from where we were last year. We were growing around 3% last year. We're talking about more like 2% growth. 2% growth is definitely less than 3, but it's still a little bit stronger than what we think the potential for the economy is. So given that the economy is quite strong, given that I do think that inflation is going to be very close to 2%, and given that the growth in the economy is satisfactory, I think that's an environment where you don't have to take a lot of action. Now, should the economy change, if the trade situation changes dramatically, if we start getting surprised by how slow China or Europe are, then that's something we definitely should react to.
There are pockets of weakness, though: manufacturing, industrial production, capital spending. What story is that telling?
So we care about GDP overall. We don't target individual components of GDP. So consumption's quite strong. How do you get, with consumption strong, a 2% growth rate when consumption's 70% of the economy? It's implying that business fixed investment's going to be a little bit weaker, and it's implying that the net export side's not going to provide a lot of oomph to the economy. So when you balance that all out, 70% is pretty strong. The other 30% is a bit weak. One of the reasons it's weak is because of some of the trade issues that we've been seeing. But when you balance it out, we get an economy growing about what you would expect at this stage of the cycle.
What about the bond market? It's now pricing in multiple interest rate cuts for this year. What is the bond market seeing that you're not seeing?
So one of the things that the bond market's showing, the 10-year has come down quite substantially. It's gone from roughly 3.25 down to the low 2s. My interpretation of that is a lot of the easing that's occurred. So that is an easing. It's a financial accommodation. It's less expensive now to borrow long than it was before. I would argue that the main reason that's occurring is because of the weakness in our trading partners. So the ECB has made several announcements that they are likely to continue easing. If you look at the German 10-year bond, it's negative right now. So the entire yield curve in Germany is negative. Rates in Japan are very low as well. So when global rates of many of our major trading partners are coming down, that has an influence on U.S. markets. And so one of the ways that would manifest itself is downward pressure on our 10-year rate. So I don't take as much information from the 10-year bond being low right now in terms of what that means potentially for an economic downturn. I know there are plenty of people who do focus on slope of the yield curve or focus on the 10-year bond, but I think right now in the current environment where we're seeing such low rates around the world, it's not surprising at all to me that our rates have come down. They're still much higher than they are in Japan or Germany, for example.